What are the 5 biggest mistakes that you can make that can cause the home buying experience to not be a pleasant one? First thing is not going into the process with a budget, a financial household budget where you understand your housing expense that you're currently paying now, all of your different debts, all of your different bills that you have on a month-to-month basis. You want to have a good idea of what that is. And so when you're a first-time home buyer, a lot of home buyers want to know, what do I qualify for? What's the most I can afford? How does that translate to a purchase price? Well, a good loan officer is going to sit down with you, and first question that they should ask you is, what are you currently paying right now in rent? And then they're going to have a conversation with you about what you're comfortable paying for on a month-to-month basis for housing expense. And so that's really important. You may qualify for more of a mortgage and more of a monthly payment than you actually thought. It might be a lot more than your rent. You can afford it on paper. You can get qualified and approved at that amount. But if that stretches your household budget, that can put you not on the best footing as a homeowner. You want to be able to understand what your monthly expenses are going to be once you buy that house. So that's the biggest thing I tell first-time home buyers. I'm not opposed to maxing out and seeing what you can qualify for, and maybe it is something that you can stretch a little bit and buy, but I'm not a big fan of overstretching people and over leveraging. I want to show you that up front, show you what it's going to cost to buy, show you what your monthly payments are going to be. The second one kind of goes with that, and it's buying a house with no cash. Now, I'm not saying don't buy a house with zero down, because you can definitely do that. There are down payment assistance programs that are out there that you can take advantage of if your income meets certain qualifications, and you can go to the closing table with a few $100s and be happy you didn't spend a lot of your cash to buy that house. You got some down payment assistance and you qualified. That's perfect. What I'm saying is buying a house with no cash in the bank, no financial reserves at all, that is not a safe place to be. And the reason that is as a homeowner, there's things that are going to come up just inevitably with owning a property. There's unexpected expenses, maintenance, lawn care. There's all sorts of things that could cause some unforeseen expenses. Maybe there's a wind and hail claim on your house, and now you've got a roof that needs to be replaced. You're not going to have to come out of pocket for the full roof, more than likely, because you've got insurance on the property, but your insurance deductible may be $1,000, maybe $2,000, $5,000. So I want to make sure that you have, as a rule of thumb, at least 3 months of expenses in the bank, preferably 6 or more. You don't want to be house poor, as they say. You want to buy a house and be comfortable with the house that you bought, have enough cash to take care of things and that sort of thing. So the third one that people get tripped up on is changing their financial picture after the loan approval. So let's say you are pre-approved with your lender, you're out making offers on homes, you go under contract, got the appraisal ordered, we've got everything done, we're just ready to close at this point. Sometimes buyers will go out and they need to buy furniture for the new house. So what they do is they take advantage of like holiday sales like Memorial Day. This can really trip people up. You're buying furniture for a house and they offer you the store credit card, and maybe there's no interest for a year. What that does is it hits your credit report and it shows up as a trade line on your credit report, and that just changes the financial snapshot that your lender took when you gave them your application and they approved you. It changes that a little bit, and it could change your debt to income. It could change your credit score. There's a couple different things that are working behind the scenes on your approval that most people aren't aware of. And we just want to be careful when we're buying things or making big purchases that require credit. That's one way you can change your financial picture. Another way that I see people do this is maybe they'll buy a car. Maybe they get a raise at work and they need a new car. All of these things, I'm not saying you can't do them, but do yourself a favor and do your mortgage officer a favor. Just keep them apprised of any potential changes to your financial picture. I see it sometimes where people want to pay off a credit card because they think that's going to help their score. A lot of times you would think that that would work, but a lot of times that'll actually reduce your score if you pay off and close a trade line, because now you have less credit available to you and that dings your credit. That could bring your score down. So if you can, if at all possible, keep your financial picture exactly the same. Don't change anything. Just make sure that you're keeping that in check, or if you can't, talk with your mortgage officer about it before you make any changes. The fourth one I would say is only getting pre-qualified versus being pre-approved. Now, what does that mean, pre-qualification? Pre-qualification is basically you talking with a lender, and the lender says, okay, based on the verbal information that you gave me, based on what you're telling me your income and your debts are and your credit score roughly, this is what we think you would approve for if you were to apply for a mortgage. So yes, you're pre-qualified to buy a house. Is that any good in terms of making offers on homes? Maybe in some cases, but 99.9% of the time, I'm helping people through what's called a pre-approval, which actually means you're going to spend about 15 to 20 minutes going through my online application. It's the easiest quiz you'll ever take because it's all about you. You can answer all these questions about your employment, about your income, about your assets, where you bank, how much money you have in the bank. Go through that list of questions, and at the end, it's going to ask you for a few simple documents like pay stubs, W-2s that help the lender firm up what you're telling them. And then what they'll do is they'll pull a soft credit report. Some will pull a hard credit report. I like to pull a soft credit report because it doesn't hit your credit. It lets us see everything that we need to see. And then what they'll do is they'll run Desktop Underwriter or another underwriting engine that basically does an underwrite for us based on all the information you gave and gives us an approval. So that's not actually sending it to an underwriter. That's what we do when you go under contract. That's when an actual underwriter reviews everything and just follows up what I did. But you want to have that pre-approval in hand because it allows you to make stronger offers. You're more assured that you're going to get qualified. There's less things that can happen versus a pre-qualification where I haven't had insight into your financial picture at that level. I haven't been able to pull credit. I haven't been able to verify assets and income and employment. And so there's a lot more unknowns with that. So get a pre-approval versus a pre-qualification. And if you're a seller, if I were selling a house, if someone was making an offer on my house, I would want to make sure that they're pre-approved, that they actually have an approval from a reputable lender who knows what they're doing and is not going to drag out closing and that sort of thing. So this last one on here is working with the right lender. And you knew this one was coming because I'm a broker. This is a shameless pitch. I've been doing this for almost 17 years, recently as a broker versus the retail side. I moved to the brokerage side because I have the ability to work with multiple different lenders. If there's a challenge with one lender, we can go with a different one. Pricing is more favorable, but the biggest thing I tell people is you have to have a lender that is nimble and close quickly, can get approvals either the same day, next day, can get appraisals quickly. The name of the game in this market right now, and most people don't like this, but because inventory is tight and we're in a competitive market for buyers, people are winning offers when they can close quickly, when they have a firm approval in hand, and they're making those offers on the weekends or Saturday night, Sunday night. They've got a lender that's on call that can handle those things for them. So your lender a lot of times can make or break the process for you. And that's why I like doing what I do. I feel a sense of accomplishment and reward because I'm helping somebody buy a house and there's zero hiccups. Or if there are any foreseen issues down the road, we catch those things quickly and take care of them quickly. Mortgages shouldn't be hard. You can get a mortgage in 10 days or less and get appraisals very quickly. So you want to work with a lender that you know, like, and trust. I prefer you work with a broker because they've got more options for you. Their pricing is more favorable than a retail lender and that sort of thing. Those are the 5 big things. I hope that helps you. Give me a call if you have any questions. My number is 404-561-6695. If you found this video helpful, give me a like, hit the subscribe button. I'm pushing out videos of just things I've learned over the years and things that help people and just even common questions that I get. So thanks for watching.